Well, it turns out cash isn't always what it seems. A new study found some surprises when it examined the balance sheets of some of the nation's biggest companies. Leslie Picker joins us right now. She's got more of an explanation on this story. Leslie, good morning.
Hey, good morning, Becky. That study found that some of the biggest companies we talk about here, Apple, Alphabet, Microsoft, are each running mini bond funds that appear as cash on their balance sheets. Researchers at Columbia Business School poured through the footnotes of filings, and they found that companies' holdings of other companies' corporate bonds amounted to $390 billion by 2017, or about 25% of corporate financial assets. Now, there's little transparency about the risk levels of these bonds, and during the pandemic-induced market shock earlier this year, many corporations which appeared to be cash-rich on paper could not sell their bonds to free up actual cash.
The fact that the market was so distressed prevented a lot of corporations from wanting to sell. So in some sense, they were stuck with these very illiquid assets that I often like to call them kryptonite, right? So you think this is supposed to be a safe pile of cash for a rainy day, and actually in bad times, these corporate bonds turn into kryptonite that you cannot use at all.
The researchers are urging policymakers to take a closer look at the larger systemic risks to the bond markets as a whole as a result of these holdings, Becky.
I would think some of the risk to the bond markets, Leslie, would be if all of these companies were told they had to sell all of those holdings at the same time.
Exactly. And he said that even just one company, even if just Apple, which is the largest holder of corporate bonds, even if just Apple had to sell their holdings, it would be akin to the largest bond fund blowing up, essentially. And we know what would happen if the largest bond fund blew up. We saw it, back with long-term capital, blowing up, and the impact that had on the markets. So he is saying that, we should really pay close attention to this and look at it as something that, at least just to be transparent about the risks that are out there.
Yeah, I would also think, though, if you've got a cash hoard that's, $170 billion or something, that it wouldn't be a bad idea to have some of it in corporate bonds. You're probably not going to need all of that cash at once. It just seems like with anything, as long as you're prudent about the way that it goes and the percentages that you have in each of them, maybe it's the right thing to be doing.
Exactly, and that's why companies have been doing it, is because they were looking for yield, especially companies that earn a lot of their income overseas. They were doing it for tax purposes. They figure it's easier to keep it overseas, earning some kind of yield, than it is to bring it back, pay taxes. Oh, and by the way, it's just in cash, which is earning nothing. So companies were doing it kind of as a prudent portfolio management strategy. He points to in the research Ford, the example of Ford, which isn't quite on the same level as Apple in terms of cash-like instruments, and when they needed to free up some cash during the pandemic, they weren't able to.
Yeah, smart strategies depending on how you use it, how much cash you have on hand, how much you need.